Can you guess what helped Starbucks go from a small local coffee shop in Seattle to a global coffee giant? Borrowing capital. While Starbucks founders did not have large capital to take this small brand global, they did have a solid strategy and weren't shy to borrow money and back their idea. Hello and welcome to a new video of the Polynomial Academy, a series where we will discuss the most important crypto trading and DeFi concepts. Just like Starbucks founders, traders can also borrow money to grow their business of trading the markets. This is called margin trading, and it is a method of borrowing money to invest or trade in undervalued assets with the expectation of making substantial profits even after paying back the borrowed sum. In today's video, we will understand what margin trading means and look at some of its types. Speaking of returns, subscribing to this channel is one of the best uses of your time. So make sure you do that, and now we'll get started with this video. Margin trading is like borrowing money to buy a house. As with a down payment on a house, you need to put down some collateral to trade on margin. Normally, crypto trading platforms give you a 5x, 20x or even 50x margin. At 50x margin, you will be able to trade a $5,000 position while only putting down $100. Amazing, right? But remember, everything comes at a cost. Consider a $1,000 trading account with $500 used as a collateral for a trade, leaving $500 as safety buffer. If your account balance drops to $550 due to mounting losses, you might receive what's called a margin call. This is similar to a bank warning when your checking account balance is really low and you need to add more money to it. If you don't act on the margin call as well, and your account balance continues to drop further to say $510, you risk liquidation, where the exchange sells all your holdings to cover your losses. Now that you understand the benefit and risk associated with margins, let's take a look at the types of margins available to you as a trader. There are primarily two types of margins. The first and the most widely used one being cross margin. You can think of it as using the same bank account for all your transactions like expenses, investments, and savings. For example, if you have $1,000 and you are using cross margin to trade both Bitcoin and Ethereum, this means that you're sharing the same collateral for both the trades. If one of the trades starts losing money, it would risk the entire $1,000 and a severe loss may lead to liquidation of the other position as well. It works both ways though, as a profitable trade can offset losses in the other one and prevent liquidation. The second type of margin is called isolated margin. It is the exact opposite of cross margin, where you can't share the same capital across multiple trades. It's like having separate bank accounts for savings, expenses, and investments. So your $1,000 would now be split into two separate wallets in this case, one for the BTC trade and the other for the Ethereum trade. This ensures that even if one trade loses money, it will only affect the associated wallet while keeping the other one safe. There is an interesting recent innovation in the world of margin trading called the multi-collateral margin. It allows traders to use a variety of different assets as collateral for their trading positions. Usually, you need to use a specific asset as collateral when entering a margin trade. For example, most margin trading platforms accept popular stablecoins as a collateral. But multi-collateral margin provides the flexibility of using a combination of assets like Bitcoin, Ethereum, and other altcoins as collateral along with stablecoins. This diversification in the collateral helps in managing the risk more effectively. If one asset's value drops, you can still rely on the strength of other collateral assets to maintain your positions and reduce the risk of liquidation. Now that you know about multi-collateral margin, let's understand how you can use it on the Polynomial platform. Any synth token can be used as a collateral for margin trading on Polynomial. Let's say you deposit SBTC or SETH into your margin trading wallet. The total value of these assets is displayed in terms of SUSD. We don't actually convert these assets since you have the ownership of them, but stating the combined value in SUSD terms makes it easier for you to keep a track of the market fluctuation. That's it, you're ready to take leverage and start trading on Polynomial. In case you close a position at a loss, the assets used for collateral is automatically deducted, converted to SUSD and used to cover the shortfall. margin trading is a double-edged sword. And while it might seem like a quick way to make money, it is an equally quick way to lose money as well. It is about having the right knowledge and discipline to use margin trading to your advantage, and we are building this Polynomial Academy series to help you do exactly that. So subscribe and press that bell icon to avoid missing out on other useful videos. I'll see you in the next one.